after a wonderfully lucid and insightful presentation by Ramdev, I think it's a privilege for me to be here moderating what I think is a panel of, truly knowledgeable and thoughtful people. And before we actually get into what the study dealt with, I think we should use the opportunity that we have, since we have people who themselves have created in their careers significant amount of wealth at the organizations they've worked and been involved in a process where it has been created. I'd like to go around the table to ask each of them, maybe spend a couple of minutes telling us what in their opinion are the most significant things that lead to the creation of wealth in the context of a corporate setting. So Amit, would you like to set us off?
Thanks.
And this is your personal experience.
Sure. So I think my personal experience in the first innings of my career was really with DSP Merrill Lynch, which interestingly did land up being a great story of wealth creation for the Kothari family. And that too in an industry where, which is today notorious for not having created wealth. I think my simple takeaways when I reflect back on what really drove wealth creation at DSP was really just getting the basics right. I think Hemendra was an incredible leader who was very clear that financial services was essentially a business about people, and so he really focused on making sure that he got what he truly believed were the best possible people in the business, creating the right incentive structure around them, ensuring that greed did not get the better of them in an industry where greed often creates great value over short cycles, but can destroy institutions, as we have seen it happen in the West over longer cycles. And then I think another theme which I think was unique which comes through a lot in some of the companies that Ramdev talked about in his presentation, was really thinking hard about building strategic differentiation, being very clear on what does it take to be ahead of the market and reinvesting some of the gains that you get from that in being ahead of the curve. I think there was an incredible focus of that at DSP, as opposed to just short-term profit maximization, just making sure that money kept going in on making people investments, on doing things which were atypical in the market at that point of time, in order to build that moat that Ramdev keeps talking about. And the third takeaway actually is very interesting, which is a good takeaway again from the wealth creation survey, which is essentially businesses with high return on capital employed. The odds are generally, the tailwind is behind you, and the odds are generally in your favor. Avoiding making investments in really capital intensive stuff was something that I think DSP was great at, and that I think enormously helped again create wealth on a sustainable basis. I think to put it in context, I think Hemendra started with a few less than a couple of lakh of rupees, and I think the company when we finally sold it to Merrill was worth $1 billion.
It's amazing that you should say this, the third one, because when I was very young, I started life in a credit rating agency, and I used to be always amazed that the companies which had the best credit quality were the ones who didn't need to raise debt. So it's something similar to that, it's along those lines. But I mean, if I heard you right, I think in essence what you said, and please correct me if I'm wrong, is clarity of purpose, taking the long view, and the ability to do business, grow the business without having to put in large incremental sums of money to achieve that growth.
Absolutely.
These were,
I think these were really the unique factors.
Mr. Singhvi, you also have had a very privileged perch. You have done wonderfully in creating some outstanding organizations, and as a banker in your second innings, you've also been associated with some of the best names in this country. Would you like to share what you have seen and what you believe leads to whether you call it value, wealth, whatever phrase you choose to use, which differentiates really top-drawer companies from the less than rewarding companies?
Well, I'll dwell more on my experience with Ambuja, and I think Ramdev insisted that one of the companies for 10 years consistently coming into the study. I'll just first start with one basic factor, which was that when I joined the company, there was an IPO just happened then for a total market cap of $5 million. And when in 2006 the company was sold out to Holcim, the total valuation of the company was close to $6 billion. So I saw a journey from 5 million to a 6 billion to 100 times in just about 22 years. And a sector which I have a great respect for Ramdev and very huge affection for him, I've known him for almost 25-30 years, but he never liked that sector at all. So to create the wealth in a sector which Ramdev never liked, I think to a very large extent, I feel
that's against God. It's almost God.
Very vindicated here on that. And I remember when in '89 there was a right issue of Ambuja Cement, and I offered some shares to him, and he refused to buy those shares. He said, no, I don't think cement can ever create wealth. So coming back to that and taking that as a cue that the Ramdev did not believe in it, we still proved that there can be some value creation there.
And Mr. Sethi, with your permission, I'll stop you for 1 second because this is real life. And I suffered a fate even worse than Ramdev. So I was offered renunciation form by some completely, person, benighted soul who hadn't a clue, again, that Ambuja was going to do so well. So he came and left me a renunciation form and said, take it, I have no use for it because this company just simply isn't going anywhere and I don't want to put more money. And my misfortune. I was prevented from buying shares because I was an analyst at CRISIL. Can you imagine how work gets in the way of making money?
In your case, it may have been a compulsion, but in Ramdev's case, it was completely a choice.
So, that's right, it was voluntary.
Maybe that is what made Ramdev start doing this study and figuring out.
But he did much better. So let me just come back to this, that what we did in Ambuja as compared to, and I remember there were about 6 more IPOs at the same time in '86. So I'm taking you back from probably the time when you were not even born. But I just want to dwell on that, and how you can create value over a period of time in a very mundane, very commodity business. I mean, cement is a completely commodity business, as you would all know. But I think one thing which differentiated us from others and where we constantly and continuously really worked on, that in a commodity business, produce cement as a commodity as far as the factory is concerned, but don't sell cement as a commodity in the market. What does that mean? It's exactly what Ramdev was talking about, creating economic growth on a sustainable basis. That will keep your costs low. Produce cement as a commodity. That means every ton of cement what you produce has to be lowest cost producer. But don't have a mindset when you are selling in the market, because then you can't just be throwing the commodity and other guy is buying the commodity and he's going to really squeeze you out, because then you have squeezed both sides, on the side of the cost and on the side of the pricing. So this is what we learned hard way, because we were extremely competitive in that market. And cement market, my dear friends, continues to remain very competitive. In fact, it has become more competitive now than it was ever before. But in that market, to consistently make money, I think this is the only way you can create both profits, or sometimes I would use the word superlative profits, but more importantly, create that kind of an entry barrier. But otherwise, how do you create an entry barrier in cement? Everyone can find limestone deposits and start a cement plant. But you create an entry barrier by way of keeping your costs so low and selling an industrial product as more as a brand. And I think this was one of the huge advantages which we saw in Ambuja, that on a consistently basis, on almost 25 years or 24 years, I worked with that company. And important factor is that after it was taken over by Holcim, which is a very large, second largest cement producer globally, they haven't changed the brand name yet. It would be one of the very few examples where you buy such a large piece and you still keep the same brand. So that shows that in a commodity business, brand plays a big role and big value of that. Second point which I would just like to dwell on, and I think taking a cue from where Amit left, that not to invest money into capital intensive situations and keep your, as you rightly said, that a company, to my mind, a AAA company is a company which never should borrow money. Why do they think rating? I don't know. Yeah. So but being in a capital intensive industry where I come from, in Ambuja, I think it is a very important factor to look at how judiciously you really keep an eye on your capital employed. Because it can guzzle, and you can't, one wrong decision can take you completely away. In fact, Ramdev, I would suggest that you talk about wealth creators, but I think you must have one study done, at least for my understanding, how people have destroyed wealth. And where did they go wrong? And particularly like telecom, because it's again a capital intensive industry, where they've gone so badly wrong. Competition will always be there. I don't think you can do away with the competition. India is a highly competitive economy. It will remain very, very competitive. Because by nature we are entrepreneurs. By nature we would compete. So I think, as I draw back on my own experience on that you've got to be having a strategy which is going to work on a long term. And in a commodity business like this is only keeping the cost low. Don't sell your product as a commodity.
Right. Thank you very much. I think, what you said is something that is now part of accepted wisdom. They actually teach this at the business schools, that one of the three sources of competitive advantage is being the low-cost producer, and that's exactly, so you're absolutely spot on. Now, Ramdev, I have a question for you. Obviously, you spoke at length about, wealth creation, and, Mr. Singhvi pointed out what led you to the quest for wealth creation. You just had a bad start, so it's obvious that you put in a lot of effort in staying ahead of the crowd. If you missed out on Gujarat Ambuja 25 years ago, shame on you. But here's my question. You spoke today about a number of things, very interesting concepts, and we'll come to them soon, like the competitive advantage period, valuation agnosticism, earnings agnosticism, and so on. But I'd like to ask you something which, and you quoted Buffett extensively, because this really is, what he talks about. But he also emphasizes the primacy of something which in his mind has been fundamental to creating wealth, which is the importance of what he calls capital allocation, rational capital allocation. And we didn't hear much from you on that in the course of your presentation this evening. So would you like to sort of give us your thoughts on how this works in the context of wealth creation? There are slides which talk about dividend payout, there are slides, Mr. Singhvi made I don't know whether Amit or Mr. Singhvi, I'm sorry, senility creeping in here, but clearly wealth creation need not necessarily always be organic, it usually is, but that's one of the places where you can really blow up money. You can have irrational capital allocation. So what are your thoughts on this?
About
capital allocation and its role in wealth creation, given that you have a company which has all these characteristics. How important is it? Are we agnostic to that as well?
No, this entire study is the basic foundation, and the testing has happened only on the capital efficiency.
No, on the capital allocation as opposed to efficiency. So allocation is, let's say you're very profitable, you make heaps of money, now you've got to use that heaps of money. So, Mr. Singhvi made a wonderful point. Indian companies, I used to be staggered, but I still am staggered by lots of things. But they used to say we're doing a wonderful thing. They're using retained earnings to pay down debt. I mean, that is the closest thing to absurd that I have seen in my life. Using money which costs you 16% to pay off money which costs you 6%. But they all love to say we become debt free because we paid off our debt using retained earnings. That is capital allocation at its worst. You can't beat that.
But we have seen real bad wealth capital allocation in the last 7-8 years. The size and I think it started with Mr. Alan Mittal becoming world's third largest, richest man. And I think somewhere some of the Indian counterparts, they also wanted to bridge the gap very quickly. And in that process, and probably there was some problem in growing in India also. So at least that was a contest in which a lot of very large acquisitions happened. And I think one other thing also was that the way the global economy and local economy was going between 2003 to 2007, it was very, very rapid growth in the economy. So at that point of time, the entrepreneurs who had not seen this kind of a cycle, they got engulfed in the cycle, and they bought, the market cap of their own company got into their head, and they started acquiring companies, keeping the market cap in the mind rather than looking at the balance sheet.
Right.
And then what happens is, when you buy a 10 or 12, 14 billion dollars of company, of course the banker has the job. I mean, he comes in very smartly and he pitches how exactly you are going to, how nice it is. You are
Synergies. He shows you the synergies.
Synergies and the cost of capital, literally no cost of capital, 3%, 2%, and sir, here is your EBITDA and only to
How much you will save in the next 3 years, all of that. Yeah, okay.
So all kinds of, so he is very successful in collecting his $500 million piece and gives you the, but the owner.
But how come these smart guys who are on that list,
Yeah.
how come they didn't get this itch? What have they done right vis-a-vis capital allocation? Or is it just a mixed bag? Some have got it right, some have got it wrong. Amit, you want to come in?
So, I think first of all what you've raised is a very, very fundamental and central question to value creation. I'll make 3 simple observations I've had working with a lot of companies over the last 20, 25 years. So I think capital allocation, first of all, the first rule should be you should allocate as little as possible. And what I mean by that is, if you can fundamentally be in businesses which are not very capital intensive, I spoke about that as a theme. I think generally the odds from a long cycle perspective are against you in capital intensive industries versus other industries. And sure, I think Anil made a great point that you can take certain capital intensive businesses and make them a little bit more consumer facing, in which case your returns will be better because that brand premium that he was talking about drops to the bottom line and gives you higher ROE. But I think if you were to try to generalize, businesses which have higher return on net assets over long cycles will generally create higher value. So if you're an allocator of capital, you should allocate it to businesses where capital requirement is sparse. I think that's the first thing. I think the second thing is, another great point you made, which is when you're allocating capital as a owner of a business, I think if you can allocate as much of it possible back to shareholders via dividends as opposed to keep it, on your balance sheet, I think you'll generally see better value creation. Again, this emerges every year in Ramdev's study when you look at the correlation between consistent dividend payers.
So you need to think long and hard about dividend policy.
You need to think very long and hard. And I think in general, even if you're a great business, hoarding cash is a millstone around your neck. And I think when you think of the value creation which has happened in TCS versus Infosys, I think there are 2 lessons to be learned there. One is, of course, there's a lesson on growth, but I think there's also a lesson on balance sheet efficiency and whether cash should have been hoarded versus given back to shareholders. I think the third lesson, and I speak this as a former banker, is as little as possible for inorganic growth.
So you're saying acquisitions in general, they should have a label on it like
there's adequate data out there, and I'm a believer
that acquisitions don't work.
Yes, that acquisitions generally don't work. 2/3 of acquisitions destroy value, of which 80% of them happen because people get lulled into believing that they're synergies. So
SEBI should become like the Department of Health. They should put skull and crossbones when you want to do an acquisition and say this is not on.
No, absolutely. I think